good time to welcome our market master for the day, Gautam Chhaochharia, Head of Research at UBS Securities, joins us now. Gautam, good morning. Thank you very much for joining us. Well, what's the overall sense in the markets? In a few days, you guys will also be having your investor conference. You must already have touched base with a bunch of the potential guests, both listeners and speakers. Are you guessing that this party is not going to stop anytime now? India seems a preferred destination.
Yeah, good morning. We would like to believe that we still remain bullish on the markets with a Nifty target of 9,600 for next year. But talking to investors over last few days, and specifically the ones coming in, we're definitely seeing a sharp uptick in investor interest in the conference event compared to last year. In fact, last year was a kind of a bottoming thing. And secondly, we're also seeing a lot of new investors who are willing to come down to look at the India opportunity. So that's definitely reassuring.
Okay, a word on the macro numbers that came yesterday. The inflation number down. IIP looked optically higher, but I have my worries. What do you make of first the growth number? Do you think growth is taking much longer to improve than perhaps many of, at least the market was indicating?
Yeah, we would agree, and we've been arguing that that's where the room for disappointment for markets is, that some of the exuberant expectations are slightly ahead of reality. We continue to believe that the growth recovery will be mild and gradual. In fact, our GDP growth forecast is 5.5 for March 15 and 5.8 for March 16, and 6.5 only for FY17. So we do expect a mild and gradual recovery, so for us it was not really a surprise, but I would guess pockets of the market would see this with some concern.
Hi Gautam, good morning and thanks so much for joining in. One of your interesting calls is that you're underweight on two-wheeler autos as well as neutral on four-wheelers. And off late we've seen autos, both two-wheelers as well as four-wheelers do very well in trade. What explains this cautious stance that you have?
So two-wheelers cautious stance is reflective of multiple things. So one, the stocks have done well, valuations to begin with. Secondly, the competitive intensity in the two-wheeler space. And third, most importantly, when we talk of our economic recovery, we don't see two-wheelers surprising positively. There's the amount of quantum of pent-up demand, as per a primary survey we ran 2 months back, is actually quite small and insignificant for two-wheelers. So the positive surprise from growth for two-wheelers when the economy recovers is likely to be limited, while the pent-up demand quantum and therefore ability to surprise even on current revised estimates remains quite significant for Maruti. So we continue to like Maruti as a preferred four-wheeler name and still recommend avoid two-wheelers.
Okay, a two-part question and maybe not entirely related. Tata Steel numbers disappointed because they did badly in the Southeast Asia region. Separately, the rupee has had a stunning record of appreciation, which will chip into exports, won't it? So, your comment on Tata Steel itself, and basically whether you will now start worrying about those who were making their money on exports.
Yeah, so the export story, again, what we have seen historically, not just last year around the September currency move, but even from a longer term perspective, these small differential moves where, say, rupee has outperformed or underperformed and therefore looks relatively marginally better on RER or relatively worse off, these do not really play a big role in exporters, either performance in terms of growth rates or in terms of near-term earnings, while a big move does play a role. So at this stage, we would argue that the moves we have seen in the currency is not that significant enough for us to get worried about either exporters in terms of earnings outlook or even in terms of growth outlook.
Okay, I believe you've turned neutral on the small and the mid-cap space from an overweight. Is that true? And secondly, which mid-caps have you now turned increasingly, cautious of? And any mid-caps that have, popped up on your radar and you now recommending a buy? Any new stocks that you can tell us?
Yeah, sure. So we have been getting concerned on mid-caps top down for the last 2-3 months because of just very, very expensive valuations. And we have been on kind of a downgrading spree. So we've downgraded TTK Prestige, we've downgraded Havells, we've downgraded Kajaria Ceramics. A lot of these stocks which still have great opportunities from a 3 to 5 year perspective. So investors looking at that time horizon obviously should look at it differently. But from the next 1 year perspective, from the current valuations, current street estimates and our estimates, we see limited upside. The stocks where we continue to see significant upside from a 1 year perspective in mid caps, and these are our top picks, remains MCX. That's one. Second is Bajaj Electricals, where we see restructuring related re-rating opportunity, and third is Exide.
Okay. All right. Speaking of Exide, what about the other auto ancillaries? I mean, we saw Motherson Sumi kind of in line. Some were squabbling with the numbers. Bharat Forge was eye-poppingly good. The entire auto anc space?
So you don't have a formal view on auto ancs as such, but because each of the companies is very, very different.
Yes.
But Motherson also is one of the mid caps which we downgraded three months back, again on valuation. So again, from a near-term perspective, the upside seems limited to us in that name.
All right. What's the general performance of FMCG companies giving you, FMCG and consumer goods companies giving you in terms of any buys or sells in that space? Were you disappointed with generally the level of performance?
Not really disappointed, because we're not expecting any sharp uptick in growth rates given our view on growth recovery pace and festive season. But yes, the growth rates didn't really excite the markets. What was disappointing at the margin and in few companies were the margins, because there were some expectations that moderating commodity prices will lead to margin positive delta. That didn't really play out. And that's again a classic issue of competitive environment, because these companies would typically use these opportunities to reinvest in the business and strengthen market position rather than just retain it for margins. So that's the other part. The name which we continue to like in consumer staples is ITC, and in discretionary it's Asian Paints.
Okay. Gautam, to play this next leg of rally from 8,400 to 9,600, which is a 15% upside, if retail investors want to play this rally, via a basket of, say 5 stocks, which Nifty stocks would you recommend at current levels?
I mean, what takes it to 9,600?
What takes it to 9,600 if someone wants to create a basket of stocks?
Yeah, so the names we would recommend is two banks, ICICI Bank and Axis Bank. Then among the oil and gas, ONGC. Okay. Then Asian Paints, and then Maruti.
Okay. I still want to stick with mid-cap, since you are such a master of that space as well. Off and on we see these pockets. Yesterday was the day of the packaging guys. After the UFlex numbers came in, anybody with anything to do with packaging was rising. And then logistics companies, I think every 10th day or 11th day you will have the logistics companies doing well. But there must be some gold mines in these that you like?
No, we don't have coverage, so I can't comment on any of these individually.
All right. Another area where you definitely perhaps have a view, NBFC companies, obvious beneficiaries of wholesale rates falling, and they look like they're falling if we continue to get these inflation numbers.
Yeah, so that remains one of the big overweight areas for us. We like the entire NBFC space. The key picks for us remains LIC Housing and Shriram Transport.
All right. I understand you have to run, Gautam. Thank you very much for obliging us with your views, both on the macros and the micros.